Let's talk about money, not pocket change, but the big stuff, national currencies. Think of a country's currency as its engine. When it's strong, everything runs smoothly. When it's weak, things get bumpy. Today, we're lifting the hood on Central Europe, Hungary, Czech Republic, Poland, and Romania, where currencies have been on a wild ride. The forint, crown, zloty, and leu have surged ahead this year, but what goes up can come down fast. Why does this matter? Because currency values affect everything. The price of imports, holidays abroad, and even your groceries. A strong currency stretches your money further. A weak one helps exporters, but makes imports pricier. We'll explore why these currencies have been racing ahead, what experts predict for next year, and why it all matters to you. Buckle up. Central Europe's currency rollercoaster is about to get interesting. In 2025, the Hungarian Forint and Czech Crown took the spotlight, surprising many analysts who had predicted a quieter year for Central European currencies. The Forint soared, gaining 8% and hitting a 22-month high against the euro. Investors loved it. This impressive rally was fueled by strong economic data, higher interest rates, and renewed confidence in Hungary's financial policies. The Czech crown wasn't far behind, up over 4% and reaching a 26-month high, earning a reputation for stability. Its steady climb reflected the country's robust exports and prudent fiscal management, making it a safe haven in uncertain times. Both became favorites for investors seeking safety and returns, drawing in capital from across Europe and beyond. The Polish Złoty played the steady achiever, up just over 1%, but still solid, thanks to a resilient economy and consistent policy decisions that reassured markets. It quietly hit a 7-month high, proving you don't need flash to earn respect. Investors appreciated its reliability, even if the gains weren't headline-grabbing. The Romanian leu is a different story. Tightly managed by its central bank, it doesn't swing wildly, offering predictability in a volatile region. It hit an all-time low in May due to budget worries, but the central bank stepped in to keep it steady and fight inflation, showing its commitment to stability. Each currency had its own journey. Some raced ahead, others held the line, but all reflected the unique economic stories of their countries. But all eyes were on Central Europe as these currencies outperformed expectations, drawing attention from global investors and financial media alike. The question now, can they keep it up, or is a slowdown coming? With global uncertainty still looming, the next moves are anyone's guess. Let's break down what's driving these moves, from interest rates to government policy and global trends, and what might come next as Central Europe's currencies continue to shape the region's financial future. The Hungarian Forint was 2025's high flyer, hitting 380 to the euro and giving Hungarians more buying power abroad. Investors flocked in for high interest rates, pushing the forint up fast. But experts now warn it's overvalued. The economy isn't as strong as the currency suggests. With elections looming and government spending likely to rise, the forint's foundation looks shaky. The forecast? A gentle descent, down about 2.3% over the next year, settling near 390 per euro. This isn't a crash, just a return to reality as high rates can't last forever. The forint's wild ride may be ending, with a more stable, realistic value ahead. Investors are bracing for a correction, not a collapse. The lesson's spectacular gains often come with a price. The forint's journey back to earth is already underway. The Czech crown is the region's supercar, fast, stable, and reliable. It hit a 26-month high at 24.1 per euro, thanks to a strong economy and smart central bank moves. Unlike neighbors, the Czech National Bank paused rate cuts, keeping the crown attractive to investors. The result: steady demand, strong value, and low inflation. Experts predict the crown will hold its ground in 2026, staying at the top of the pack. Confidence in Czech economic management is high, growth is picking up, and global investors are taking notice. The crown's success is no accident. It's built on policy discipline and economic momentum. With the US dollar weak, the crown shines even brighter. For now, it's the region's champion, expected to defend its title next year. Stability and strength are the name of the game. The Polish Złoty is the dependable family car, steady, practical, and resilient. Up 1.1% this year, it's held strong even as Poland's central bank cut interest rates. Normally, lower rates weaken a currency, but Poland's economy outperformed expectations, keeping the zloty afloat. Investors stuck with it, trusting in Poland's economic fundamentals. Looking ahead, experts see a slight dip to around 4.25 per euro, a gentle slowdown, not a breakdown. The zloty's stability is good news for businesses and consumers alike. No wild swings, just predictable performance. For a large economy, that's exactly what you want. The zloty isn't aiming for speed records, but it's not stalling out either. In 2026, expect more of the same steady, reliable, and safe. And the Romanian leu is tightly managed by its central bank, a precision driving event, not a free-for-all. The goal, keep inflation in check and the economy stable. The leu's value is kept within a narrow range, making it less volatile than its neighbors. But this can't last forever. Once inflation cools, the bank may let the leu weaken slightly. The forecast, a slow, controlled drop of about 1.1% over the next year, near its all-time low. Political uncertainty and a big budget deficit remain risks. The leu's path in 2026 will be about careful management, not sudden moves. The challenge: balance growth, stability, and investor confidence. Expect a gradual, deliberate journey, not a wild ride. What fueled Central Europe's currency boom in 2025? It wasn't just luck or a passing trend, there were powerful forces at play behind the scenes. The main driver? Central banks kept interest rates high, making their currencies more attractive and drawing in global investors hungry for better returns. High rates acted like a magnet, pulling in foreign money and boosting demand for forints, crowns, and other local currencies. Investors saw a chance to earn more, so they moved their capital into the region. The Czech and Hungarian central banks played it tough, creating a premium market for their currencies. Their policies signaled confidence and stability, which reassured investors. Meanwhile, the US dollar weakened, sending investors searching for better opportunities. Central Europe fit the bill perfectly, offering both growth and stability. Solid economic growth in the region added more fuel to the rally. Central Europe's economies were expanding, businesses were thriving, and confidence was high. Even as Poland cut rates, its economy outperformed expectations, keeping the zloty strong and showing that growth can sometimes outweigh lower rates. The result? A perfect storm of high rates, global trends, and local resilience. Central Europe became the place to be for investors looking for strong returns. Investors piled in, and currencies soared to new heights, making headlines and drawing even more attention to the region. But as conditions change, the rally may lose steam. Markets are always shifting, and what goes up can come down just as quickly. The secret sauce? Smart policy, strong economies, and a bit of luck. It's a delicate balance that can shift with global winds. The question now is, how long can it last? Only time will tell if Central Europe's currencies can keep their winning streak alive. After a record-breaking run, experts now warn that most Central European currencies are likely to face a slowdown in 2026. The impressive gains seen in recent years may soon give way to a more challenging environment, as the forces that fueled the rally begin to shift. The main reason? Interest rates are set to fall as inflation finally cools, making these currencies less attractive to global investors searching for higher returns. As central banks ease policy, the appeal of holding local assets diminishes, and the flow of speculative money is expected to slow. As rates drop, the foreign money that fueled the rally will start to flow elsewhere, seeking better opportunities in other markets. This shift could put pressure on local currencies and financial markets. The Hungarian Forint and Polish Złoty are expected to weaken in the coming months, while the Czech Koruna may hold up a bit better thanks to the central bank's more cautious approach. Still, all three face headwinds. Politics is another risk. Upcoming elections in Hungary and Romania could spark investor nerves and raise fresh concerns about government budgets and policy direction, adding to the uncertainty. Big government deficits and ongoing political uncertainty can send currencies lower, especially if investors start to doubt the region's fiscal discipline or stability. External shocks, like the war in Ukraine or a broader economic slowdown in Europe, add even more risk to the outlook, making the future harder to predict. Central Europe's economies are closely tied to Germany, their biggest trading partner. If Germany stumbles or slips into recession, the impact will ripple across the region, affecting jobs, exports, and growth. The road ahead is full of twists and turns, with plenty of sharp curves that could catch investors off guard. The era of easy gains is ending, and the days of rapid appreciation may be behind us for now. Now, it's all about managing the descent, navigating risks, adapting strategies, and staying alert as the landscape shifts beneath our feet. So, what does all this mean for everyday people in Budapest, Prague, Warsaw, or Bucharest? If the forint and zloty weaken, imported goods and foreign holidays will get pricier. A weaker currency helps local exporters and attracts tourists, but squeezes anyone with foreign currency loans. Stable currencies bring peace of mind, volatile ones bring uncertainty. The currency rollercoaster affects everything from your grocery bill to your summer vacation. 2025's strong currencies kept inflation down, but made life tough for exporters. In 2026, weaker currencies may boost local industries but raise some prices. The bottom line, global finance has a real impact on your wallet every single day.